Hey, what up guys, and welcome to Rad Talks. Today we're going to talk about one of my favorite topics, options. What are they? Let me go ahead and break it down for you. Options are not when you don't commit to a date because you want to keep your options open. That is not options. However, there is more truth to that than you may actually think. So options, when we're talking about trading, it really is something that gives you an option. Now, a lot of people out there have probably seen videos where they try to use this one definition, where it's basically, it's the right, but not the obligation, to buy or sell a certain amount of stock at certain said price at this. What does that even mean? That's not the way people talk. So let's get rid of that definition. Let's not think about that. Yes, that truly is the technical right definition. But let's talk about what options really are. And it is a right to be able to buy something, or it is the right to be able to sell something. So to understand this concept, we need to dig into where it even originates from, because it actually is a legal concept. And to all my viewers out there who've been to law school, I'm sure you know where I'm going. We're going to start talking about black acre, green acre, red acre, whatever acre from property. So in property class, they always have this scenario where you have Farmer Joe, Farmer Bill wants to buy green acre, and it just represents a plot of land. So they end up in a contract where they buy it. And this is also when they start to introduce the idea of an options contract. Yes, when we're talking about the stock market options, we're talking about an options contract. And there's the same principles that apply from the legal concept, because that's where it derives from. It is a legal contract. It's where it comes from. It's a legal concept. So if we go back to the simplest form in law school, what they usually do is they have like Sally or Sarah wants to buy a said plot of land from Farmer Joe. And in the process, she decides there's another piece of land that sits next to it that Farmer Joe also owns. She buys the underlying property, and she wants to sit on the option or the ability to buy that other parcel of land at a certain time in the future. So what they do is they enter into what's called an options contract. So she wants that option open and irrevocable. She does not want Farmer Joe to be able to go and sell that property during that time. Let's say it's for a year. So Sally wants to buy this property, and she buys this property, and she lives in this property. But she wants to live in it for a year, and she wants to watch the market to decide if she wants to buy the property next to it, just a flat piece of land, where then she can maybe invest in it and maybe build something on it and sell it. So they have the underlying sell, then they have this options contract to be able to buy this other land. And it's an agreement between her and Farmer Joe. And in order for it to be legally binding, there's certain things that have to be there. So you're going to have a set price. So they enter into this agreement and they say, hey, in a year from now, I'd like to be able to buy this property for $100,000. I'd like to be able to buy this piece of land for $100,000. Let's make it $10,000 easier. I want to be able to buy this land for $10,000 in a year from now. Another thing that has to be is a set time, so a duration in which this option contract is going to be open and before it expires. It can't just be an indefinite time in the future. It has to be a specific period, a specific date. So 1 year from now, so today is October, looks like the 29th. So October 29th of 2022. So if Sally says, hey, I want to be able to buy this on or before, like I want to buy it within the next year, that means October 29th of 2023 is when this option to be able to buy this land expires. All right, so those are two components right there. You have to be able to have a set price. So we've got $10,000, and we have a set time. So we've got the future date of October 29th, 2023. That year period, it was completely arbitrary here. It just has to be some point in time that is agreed upon. In addition to that, you also have to specifically detail or determine what you're even selling, or like what the option contract is for, the underlying asset. They can't just enter into this agreement saying, hey, I want to be able to buy blank. and I want to buy it before October 29, 2023, because if you took that to a court, they'd look at you and be like, what are you buying? Like, it doesn't say what you're even buying. So you have to specifically state what it is, and what you're stating there is it is a piece of land. Here it is, the parcel, bam. So you have pretty concrete facts in there. And one more thing that you're going to have to do as well is consideration. In order for it to be irrevocable, there actually has to be some sort of good or value, something that was actually traded in order for this contract to be binding. Think of it as money, because it always comes down to money. And when we're talking option contract in the stock market, it's money. So it has to have some sort of consideration. Those last two components are what we're going to dig into right now. So the money aspect is what's referred to in a stock option as a premium. And when we're talking about the underlying asset, this is key. So up till now, what we've talked about is Sally wants an option contract to be able to buy this parcel of land within a year, with the specific time, be on or before 29th of October of 2023, it's 1 year from today. She wants to be able to buy that land for $10,000 if she wants to. Now, a couple things happen here. She can also walk away. And let's say they agreed on $100 price for this option contract. So if she walks away and she says, nope, I'm done, you can have that land, you can sell it to someone else. She rips up the contract, she revokes it, she's the holder of the contract, she has the right to be able to do that if she wants to, or just wait till the expiration without giving notice that she's buying the land, in which case Farmer Joe keeps that $100, the consideration, or in stock terms, the premium. He keeps that, and he now has the right to be able to sell his land again. He doesn't have to sell it to her, he doesn't have to sell it for $10,000. The reasons why Sally may want to do this is, say the price, the real estate market's been going up and down, which actually that's pretty accurate of the last couple years. If you look at this since 2020 till now, and right now we see it, kind of tapering off a little bit. So in that type of situation, let's say she had entered in this in 2020. She said, I want to be able to hold on to it, maybe have the right to be able to buy it $10,000. Well, fast forward till 2021, or it was a 2-year contract, and now today she's like, yeah, you better believe it, I'm going to buy that for $10,000 because it's now worth $150,000. That's what we're talking about here, is you're getting the right to be able to buy something. Sally gets the right to be able to buy this piece of land, and she gets to decide, she gets to wait and sit on it. She's the only one who can buy that piece of land for the next year, and then she can make a decision in 1 year from now, do I want to buy it or do I want to walk away? The reason she would want to buy it in a year from now, say the value of the property is now $25,000. So in a year from now, she's going to say, yes, I'm going to buy it. So she already paid $100 to Farmer Joe for the consideration. That is separate. So now she pays a $10,000. So she ends up paying $10,100 to buy this piece of land that is now worth $25,000. So she turns around and she sells it, and she makes herself almost $15,000. That's why someone would want to execute an options contract. And we're talking about a physical piece of land here. Reasons you wouldn't want to are the exact opposite. So if you take that land, she says, yeah, you know what, market's probably going to go up, but I just want to play a little safe. I don't know necessarily if it's going to go up or if it's not going to go up. I want to play a little conservative. I just want the option to be able to buy it. I don't want to commit today. I want the option to be able to buy it in 1 year from now. So in 1 year from now, she looks at it. So when they entered into it, fair market value for that was $10,000. And in 1 year from now, say 2023 rolls around, October 29, 2023 rolls around, and that property is only worth $1,000. You think she's going to buy it? No, absolutely not. She wants to get as far away from the property as possible, so she walks away. Farmer Joe, yes, he still keeps his $100, but he also has he has the right to go sell that property, but that property is only worth $1,000. So now Farmer Joe's going to have to figure out a way of that land, make him some money. But that's his problem, not Sally's problem. So Sally has a huge advantage here because she took an options contract, because she literally has the right to be able to, in a year from now, make the decision, should I have bought it, should I not have bought it? She gets to go back in time and actually make the purchase. This is the same concept as the stock market and what we're talking about when we're talking about options contracts with stocks. So whereas we had a specific asset type of a property, a physical piece of property you go walk on, you can go look at, you put a fence up and build a house on. That's what we were talking about with Sally and Farmer Joe. When we're talking contracts with the stock market, usually what we're talking about is a set of 100 shares of that underlying ticker. You can have different numbers. There's different reasons why you would have different numbers. If there's splits, mergers, different things like that. But we're just talking about the standard, traditional. You go on your platform, you pull it up, and you place a trade on an option. 99.9% chance that what you're placing a trade on for that option is going to be an option to be able to buy or sell 100 shares of that underlying asset. And this is where it's the exact same things what we were just talking about with Sally and Farmer Joe, what the options contract is. When you look at this, you have this thing called a premium. So the buyer is the one who's going to go and buy the contract, and they're going to buy the right to be able to buy these shares or sell these shares. And they're going to pay that premium, and they have what's called the strike price. Before, when we were talking about Sally, they had agreed upon a $10,000 purchase price. So when we're talking about options, we're talking about the strike price. That's the same thing. The $10,000 purchase price over here for the land is a strike price for this stock. So what you're doing is you're entering into an agreement to either buy or sell these stocks, 100 of them, at a certain price. So let's say you have a strike price of $10. Well, then that means you'll be able to either buy them or sell them at $10 for 100 of them. So what that means, there's a couple types of options. The two that we're talking about are puts and calls. So when we're talking about calls, what you're doing is you're getting the right to be able to buy those underlying assets. So you're getting the right to be able to buy 100 shares of that ticker at that strike price or at that set price. So in terms of Sally and the farmer, she was getting basically a call type option to be able to buy that land at a strike price of $10,000 at a future date that it would expire of 1 year from now of October 29th, 2023. So when we're talking about the stock, let's say XYZ stock, let's say that you're looking at a call option. Again, calls. It's the right to be able to buy. And these are all from the perspective of the buyer. The holder of that contract is the one who always has the right to be able to execute it. So if you buy a call, what you're doing is you're buying the right to be able to buy 100 shares at a certain price. So why would this be advantageous to you? Well, just like in the case of Sally buying this property over here, she buys this option for $100. She doesn't have to put $10,000 in to buy the property. She can pay $100 a day, have the right to possibly make, in our scenario, is $15,000 in a year from now, or walk away. Same with these stocks. You're buying XYZ stock. You're saying, okay, I want the right to be able to buy it at this strike price. So let's say it's a $10 strike price. Let's say currently the value of the stock is $10, and you're going for $10 strike price, and it's a $1 premium. So what you're actually saying is, I want the right to be able to buy 100 shares of XYZ stock in 1 year from now, or whatever the duration is. You can do, for some of them, they're even almost daily or every other day. Some are weekly, some are monthly. You can go out there and you can say however far out you want to go for. So, and that's going to change all these, all the numbers that we're talking about. And I'll explain how those actually change in more episodes as well. But what you're doing is you're saying, all right, I want the right to be able to buy 100 shares of XYZ stock at $10 a share in 1 year from now, and I am paying today the $1 premium, but it's $1 per share. So I'm going to pay $100 today to be able to have the right to be able to buy 100 shares in the future at $10 a share. That's the exact same thing that Sally did, except with property. This is just a set of 100 shares. So if you ever get confused, just try to remember the scenario of Sally and what she was wanting to do with that property, why she was buying it, why she was holding that option open. And that's what a call is looking like. So you'll get the right to be able to buy these at a future date. So then fast forward 1 year from now, let's say that XYZ stock is now worth $25. Well, great. You're going to buy them. You're going to buy 100 shares at $10 in the future from now when they're actually worth $25 a share. So yes, you already paid that premium. either way, you pay the premium. The premium is gone. That does not factor into your cost that you're buying here. That's separate. That's a premium. Now, 1 year from now, you're buying 100 shares of XYZ stock, $10 a share. So 100 times 10, that's $1,000 that you pay. And you're getting shares that you can literally turn around and sell on the market just like that for $25 a share. So 25 times 100, $2,500. $2,500, you bought them for $1,000. That's $1,500 profit right there that you walk away with. Now, granted, you had to pay that premium, that $100 premium. So really, that's $1,400 that you're making profit. But that's still profit that you made. Now, let's say instead XYZ stock tanks. Let's say it goes down to $5 a share. In a year from now, do you want to buy? Let me ask you this: do you want to buy XYZ stock for $10 a share when you can turn around and sell it for $5 a share? Or, ask another way, do you want to buy XYZ stock for $10 a share from me when you go to the market and you can buy XYZ stock for $5 a share? No. So you'll walk away from that contract. You'll do what's called letting it expire, and then it just disappears. You lost your premium, so you lost $100, but that's better than losing the $500, because had you bought the shares at $10 a share, you would have paid $1,000 for something that is now only worth $500. So you just mitigated your risk by using and leveraging an option contract instead of buying the underlying shares. That's what a call option is in a nutshell. If you want me to go in more depth on this or another topic, hit me up. Let me know what you want to see. And as always, if you found this helpful, please go ahead and hit that subscribe button.